The federal government knows it. Your local tax assessor knows it. Your bank certainly knows it. But nobody is going to call you to tell you that you are overpaying. Right now, a standard retired couple in America is handing over $3,400 to $9,200 every single year to organizations that have no legal right to demand that money. It is not a fine. It is not a penalty. It is a quiet, systematic extraction based on one single thing: your silence. These institutions operate on a very specific business model. They assume you are too tired, too busy, or too polite to look at the fine print. They assume you will just sigh, pull out your checkbook, and pay the fee, because that is what you have always done. Let us break that habit today. Think about your monthly budget. Think about how inflation has chewed through your grocery bills and your gas prices over the last 3 years. Now imagine getting a check back for $4,000. That is not a government handout. That is your own money being pulled back out of the pockets of corporations and bureaucrats who counted on your lack of information. We are going to open 2 massive loops right now that you need to watch closely. First, there is a specific property tax freeze document that 30% of eligible seniors never file. If you live in states like Texas or Illinois, this single piece of paper stops the local government from inflating you out of your own home. Second, we are going to look at the exact 7 magic words that force traditional banks to wipe out monthly maintenance fees instantly. Online banks like Ally and Capital One are already using this secret to steal customers, and your local bank manager is terrified you will find out how it works. This is not a lecture about cutting back on your morning coffee. This is a tactical blueprint. We are going to go through the exact scripts, the exact phone calls, and the exact laws that protect your hard-earned retirement. Let us start with your home. Property taxes are the silent killer of retirement security. You worked 30 years to pay off your mortgage. You finally own the brick and wood. Then the local county appraiser decides your neighborhood is hot. Suddenly, your home value jumps by $80,000 on paper. You did not sell the house. You did not get a raise. But your tax bill spikes by $2,000. For many seniors, this is the moment where they realize they might get forced to downsize. But here is the data they do not put on the front page of the county website. Look at Texas. Voters passed Proposition 4. That law expanded the school homestead exemption from $40,000 to $100,000. More importantly, it created a hard tax freeze for homeowners over the age of 65. Look at Illinois. They have the Senior Citizens Assessment Freeze homestead exemption. If you are 65 or older and your total household income is under $65,000, the state locks your property assessment value. Even if the housing market explodes next door, your tax base stays exactly where it is. Yet, data from the Center on Budget and Policy Priorities reveals that nearly 1/3 of eligible seniors never receive this relief. Why? Because the county clerk will not automatically apply it to your account. They will happily bill you the full, unadjusted amount until you walk through their door. You cannot wait for a friendly letter in your mailbox. Administrative systems are fully automated to collect your money, but the mechanism to give it back is strictly manual. You have to trigger it yourself. Imagine walking into your local county assessor office. Do not go in there asking for a favor. Do not go in there sounding confused. Walk up to the desk and use this exact approach. State your name, state your age, and hand them your identification. Tell them you are there to audit your homestead exemption status for the senior citizen tax freeze. If the clerk hands you a generic brochure and tells you to look it up online, do not leave the counter. Look them in the eye and say, "I need the affidavit for the over 65 property tax freeze, and I intend to fill it out at this desk today." When you say those words, the dynamic changes. You are no longer a polite senior citizen hoping for help. You are an informed taxpayer demanding the execution of state law. They will find the form. They will give you the pen. Saving $2,000 on your home tax is a massive victory. But it means nothing if you allow the federal government to quietly siphon cash out of your monthly Social Security check before it even hits your bank account. That brings us directly to the Medicare shell game. Every single month, millions of retirees look at their Social Security statement and see a deduction for Medicare Part B. For most people, that deduction is over $170 a month. It is deducted automatically. You never see the cash, it just vanishes. Most seniors accept this as an unchangeable rule of aging. They think everyone pays the same flat rate. They are wrong. The Medicare Savings Program, or MSP, is a federal initiative designed to wipe out that Part B premium entirely. If you qualify, the state pays that premium for you, putting over $2,100 back into your pocket every single year. Here is the massive shift that happened recently. States like New York have radically overhauled their eligibility rules. They completely eliminated the asset test for the Medicare Savings Program. In the past, if you had a small savings account or an old car, they would deny you. Now they only look at your monthly income. They expanded the income limits to include a vast portion of the middle class. According to the National Council on Aging, between 2 and 3 million American seniors currently qualify for this exact benefit but are paying the full price anyway. The Social Security Administration and the Medicare system do not share data automatically for this program. You can be fully eligible on paper, but until you file the specific MSP application with your state Medicaid office, the federal government will keep deducting that $170+ from your check every single 30 days. This is not a welfare program for the destitute. The recent policy updates turned the Medicare Savings Program into a legitimate asset protection tool for middle-income retirees who are getting squeezed by inflation. If you do not claim it, that money stays in the federal treasury. The Part B premium is just the baseline cost of staying healthy. The real financial trap waits for you at the pharmacy counter. That is where a second, highly sophisticated financial extraction takes place, and it continues until you hit a very specific $2,000 threshold. Let us look closely at what happens when you step up to buy your medication. Senior citizens account for the vast majority of prescription drug use in this country. Yet the pricing system has been a black box for decades. You watch your retirement account shrink because a single specialty drug costs $300 a month. You feel helpless because you cannot skip the medication, so you write the check. But the landscape changed completely due to the Inflation Reduction Act. This law placed a hard, unbreakable cap on out-of-pocket prescription drug costs for anyone with a Medicare Part D plan. That cap is exactly $2,000 per calendar year. Once your spending on covered medications hits that $2,000 mark, your copay for the rest of the year drops to exactly $0. Centers for Medicare and Medicaid Services data confirms this is now the law of the land. Yet many seniors do not understand how the timing works. If you have an expensive drug, you might hit that $2,000 limit in January or February. That means you are forced to pay a massive, unexpected lump sum right after the holidays, which completely breaks your monthly cash flow. This is where the hidden mechanism comes in. It is called the Medicare Prescription Payment Plan. It is an opt-in program that takes your estimated drug costs and smooths them out across all 12 months of the year. Instead of facing a devastating $2,000 bill at the pharmacy counter in the winter, your plan divides those costs into predictable, double-digit monthly payments. Private insurance companies and pharmacy benefit managers do not actively promote this payment plan. It complicates their billing and reduces their immediate cash flow. If you go to a standard chain pharmacy, the clerk behind the register will not tell you about the smoothing option. They will just read the total on the screen and wait for your credit card. You have to intervene before you get to the register. You must contact your Part D insurance provider directly. Do not ask them if they have any discounts. Call them and say these words: I want to enroll in the Medicare Prescription Payment Plan to cap and smooth my out-of-pocket drug costs. By using the official name of the program, you bypass the frontline customer service script. The representative must route you to the specific compliance department that handles the federal smoothing program. You protect your savings from sudden spikes, and you ensure you never pay a single penny over the legal limit. Protecting your wide expenses is a massive victory, but you are still losing money if you let your home state tax your remaining retirement income. Just like the pharmacy counter, your state tax return contains specific exemptions that require an active declaration. Think about your hard-earned retirement accounts, your 401k, and your traditional IRA. You spent decades deferring taxes on this money. Now that you are withdrawing it to live, the state government wants to step in and take a cut. The American Association of Retired Persons tracks state tax policies closely. Their data shows that 12 states now completely exempt private pension and retirement account distributions from state income tax, or they offer massive deductions that eliminate the burden for most middle-class seniors. States like New York, Pennsylvania, and Mississippi do not tax your pension distributions at the state level. But there is a catch that catches millions of retirees off guard. If you move to one of these states or if you file a standard tax return using default software, the system does not always automatically apply the senior pension exclusion. If you just check the box for standard wage income, the software calculates your tax liability based on full taxable rates. You must manually enter the specific state exclusion code on your state tax forms. For example, in New York, you have to actively claim the pension and annuity exclusion, which allows you to exclude up to $20,000 of qualified retirement income per person. If you and your spouse both have retirement accounts, that is $40,000 of income that the state cannot touch, but only if you write the specific form code on line 29 of your resident return. Tax preparers who handle hundreds of files a week often miss these hyper-local senior exclusions because they are rushing through standard templates. You cannot assume your accountant knows every single update to the senior tax code. You must look at your previous year return and check the state's schedule. If you see that your retirement income was lumped into your total adjusted gross income without a matching deduction line, you paid money to the state that you legally owed to yourself. Stopping these major tax drains will stabilize your budget, but you also need to look at the smaller, recurring expenses that hit your kitchen table every month. Look at your utility bill and your internet statement. These companies use a highly effective tactic called promotional expiration to quietly inflate your bills. When you first signed up for your internet service, you probably paid an introductory rate of $39 a month. 2 years pass, you do not change your habits, you do not get faster speeds, but suddenly the bill is $84. The company expects you to pay the increase because switching providers feels like a massive technical headache. The situation became significantly worse when the Federal Affordable Connectivity Program ended. That program provided a $30 monthly discount on internet bills for millions of low-income and senior households. When the federal funding stopped, internet service providers immediately jacked the prices back up to maximum retail rates. But major telecom companies like AT&T and Verizon created internal senior low-income bridge programs to prevent older customers from canceling their service entirely. These packages cost between $9.95 and $19.99 per month. They offer the exact same basic broadband speed you need to stream videos, check email, and talk to your family. These packages are completely invisible on the main corporate websites. You will not find them by browsing the standard product catalog. They are treated as retention assets, meaning they are only used as a last resort to keep a customer from leaving. If you call the standard customer service number and say your bill is too high, the agent will offer you a generic $5 discount for 3 months. That is a temporary fix designed to get you off the phone. You have to change your terminology. Call the utility or internet provider and request to speak directly with the retention department. Once you are connected to a retention specialist, state your case directly. Say, I am a senior citizen on a fixed income, and I am requesting enrollment in your low-income senior essential broadband tier. If they tell you that program does not exist, do not argue. Use the competitive leverage created by online alternatives. Tell them, if you cannot transition my account to the $20 senior package, please schedule a full cancellation of my service for the end of the billing cycle so I can move to an alternative provider. This phrase changes the agent performance metrics. Their entire bonus structure depends on preventing cancellations. They will search the system, find the hidden tier, and apply the permanent discount to your bill. The same principle applies to your heating and electricity. The Low-Income Home Energy Assistance Program receives billions of federal dollars annually specifically to offset seasonal heating and cooling spikes for vulnerable households. Department of Health and Human Services data shows that a vast portion of these funds goes unused every year simply because people assume their income is slightly too high to qualify. A senior household consisting of 2 people often qualifies for energy assistance even with a solid middle-class retirement income, depending on state-specific adjustments. A single application can yield a direct credit of $600 applied straight to your utility account. You do not get a check in the mail to spend. The state simply pays the utility company on your behalf, dropping your winter heating bill to 0 for months at a time. Cutting down your home expenses keeps your money where it belongs, but we must address the place where you actually store that money. Your local bank, the institution you trust to guard your life savings, is often one of the most persistent violators of your financial security. Let us pull back the curtain on your bank statement. Traditional banks with brick-and-mortar branches are facing a quiet crisis. They have massive real estate costs, expensive corporate structures, and heavy overhead. To maintain their profit margins, they rely on a steady stream of small automated fees that chip away at your balance. Data from the Consumer Financial Protection Bureau reveals that traditional banks rake in over $7 billion every single year from monthly maintenance fees and overdraft penalties. The primary demographic paying these fees consists of older Americans. These are loyal customers who prefer using a physical branch, walking up to a teller, and writing paper checks. The bank counts on your loyalty. They charge you $12 to $15 every month just for keeping your checking account open. If your balance dips below a random minimum threshold for even 1 day, the system triggers an automatic penalty. If you accidentally miscalculate a paper check transaction, they hit you with a $35 overdraft fee. Meanwhile, online banks like Ally, Capital One 360, and Discover do not have physical branches to maintain. Because their overhead is practically 0, they have completely eliminated monthly maintenance fees and overdraft charges for all customers, regardless of their age or balance. This structural shift creates a massive problem for your local bank manager. They are losing customers to the internet, and they have strict corporate quotas to prevent accounts from closing. You can use this industry anxiety to your advantage without actually changing your bank. You do not have to move your money to an online provider if you prefer walking into your local branch. You just have to make the bank manager understand that you are willing to leave. Walk into your branch, bypass the standard teller line, and ask to sit down with a personal banker or the branch manager. Do not ask them to waive a single fee. Use the exact 7 magic words that threaten their retention metrics. Look at them and say, "Convert my account to the senior 0-fee tier or close it." When you use the word close alongside the specific phrase senior 0-fee tier, the banker's screen changes. Almost every major financial institution, including Chase, Bank of America, and Wells Fargo, has a legacy account designation hidden deep within their software architecture. It is often labeled as a senior account or a lifeline account. It comes with 0 monthly fees, 0 check writing fees, and waived money order charges. The banker will not offer this account type to you when you open a standard checking account because it reduces branch profitability. But the moment you threaten to terminate the relationship, their priority shifts from maximizing profit to minimizing customer churn. They will click a few buttons, change your account code, and those $12 monthly charges will vanish forever. While you are sitting at that desk with the banker, you need to address another service that people frequently overpay for. It is an expense that appears when you are handling critical legal preparations, like setting up a living will, organizing a power of attorney, or establishing a healthcare proxy. When you finalize these vital estate documents, they are not legally binding until they bear an official notary stamp. If you take your paperwork to a commercial shipping storefront or a private legal annex, the clerk will often charge you $20, $30, or $50 per signature to stamp the pages. If your estate plan requires 5 distinct signatures, you are looking at a $250 bill just for an ink stamp. This practice is flatly wrong. The National Notary Association tracks notary regulations across all 50 states. Their legal index shows that almost every state government sets a strict statutory limit on what an individual notary can legally charge for a single public act. In states like California, the absolute maximum fee is $15. In states like Texas, it is $6. In many parts of the country, it is as low as $2. Charging a senior $30 for a single signature stamp is not just exploitation, it is an illegal violation of state fee caps. You should never pay a single penny for a notary public. Major banking institutions require their internal branch staff to hold active notary commissions to facilitate loan closings and trust setups. As a corporate policy, banks like Chase and Wells Fargo provide these notary services completely free of charge to anyone who maintains a standard checking or savings account with them. If you do not have an account with a major bank, your local public library is your next line of defense. Municipal library systems receive local tax funding specifically to provide community resources. Nearly every public library has a designated staff member who holds a state notary commission, and they will stamp your estate documents for $0 as part of their public service mandate. Now, let us close the loop on the biggest secret we discussed at the very beginning of this blueprint. If you look back over the past 36 months, you have likely already paid hundreds or even thousands of dollars in unfair property taxes, hidden bank fees, and uncovered medical expenses. You might think that money is gone forever, but it is not. There is a powerful legal mechanism called the rule of retroactive exemption. If you were over 65 and fully eligible for a property tax freeze or a state pension exclusion during the last 3 tax years but failed to file the paperwork, you can file an amended return. By submitting Form 1040X at the federal level or the corresponding amended resident form at your state level, you can retroactively apply your senior status to those past years. The government is legally required to recalculate your old liabilities and issue a direct refund check for the overpayment. The money you worked 30 or 40 years to accumulate belongs in your hands, not sitting in a corporate retention account or a state treasury surplus fund. The system is designed to take your money automatically, but you have the legal right, the data, and the exact scripts required to take it back. Look at your financial records this week. Check your bank statements for maintenance charges. Look at your state tax return for line item exclusions. Call your internet provider and demand the hidden senior tier. Which of these 7 areas is draining your retirement fund right now? Are you going to take 10 minutes tomorrow morning to make that first phone call and stop the bleed? Hit the like button so this information can bypass the algorithm and protect other seniors across the country.